everybody. Hey, thank you for joining and taking time tonight for another one of our Whenever, Wherever Wabash programs. I know several of you have been on some of the other programs that we've been doing, so welcome back to this After the Bell session with Dr. Saha. So if this is your first, please keep an eye on the wabash.edu/www page, which stands for Whenever, Wherever Wabash. We have live events like this, which includes a book review, one we are doing next month with Dr. Pittard. And then we have another After the Bell session in December on gaming. So keep an eye on those on that website. But in addition, if you have not been on that website, in addition to the live events, there are also some pre-made videos that we have on there. We are linking to some interesting stories. There are things for kids. There's a flat wally. There are coloring pages. There are Zoom backgrounds for you. So keep an eye on that. But thank you for joining today. This is scheduled to go from 7:30 to 8:30. So when we get close to 8:30, I'll jump in and maybe ask for one more question or close it up, however the case is. We do want to be fair to everyone's time. So again, thanks for joining. If you have anything, you get to chat. You can unmute and jump in, whatever Dr. Saha prefers as we go. So I want to turn it over now. You didn't join us to watch me talk, so I'm going to turn it over to Dr. Sujata Saha. She has been here at Wabash since 2017 as the BKT Assistant Professor of Economics. So this should be a lot of fun. So Dr. Saha.
Thank you so much, Steve, for the wonderful introduction. Can everyone see my screen where I have the title slide?
Yes.
Okay. And can you now see the outline slide as well? I just want to make sure that my clicker is working. Okay, perfect. Yeah, so I pretty much don't see the chat window anymore because I have two screens in which I see like the participants and then screen. So if you see something, Steve, just let me know, okay?
Will do.
Yeah. Okay, thank you. Okay. Hi, everyone. I hope everyone is doing well today. As Steve mentioned, the title of my talk is Investment 101 Plus. And if I may request, it will be really nice if I can see some faces. And if you can, to have your video on. If not, it's totally fine as well. Thank you. Okay, so before I begin, I do have a quick disclaimer, which is this session does not constitute like any form of financial advising, because of course, I'm not a financial advisor, like I'm an educator at Wabash College. So whatever I'll be presenting here today is based on my research, my teaching. I teach a course on investment in spring semester every year, and also like all the information that I have gathered so far from different sources. So this information is solely meant for academic purposes, but I do strongly believe that the information will be helpful to apply it for your daily lives for sure. I also mentioned, Steve, before that this session should be helpful for recent graduates, as you might be starting to plan for your career or retirement planning. But if we have any senior alum here, and if you have been a financial advisor before, so please feel free to share your tips and strategies at the end of the session, because I'm pretty sure your real life experience from your profession should add value to this as well. So today during this session, we would talk about these following topics or subtopics, I would say. So we will begin by talking about some basics of investing, some historical data, different investment types that's available to us. We'll do a scenario analysis. We'll talk about some popular trading platforms, and we'll spend some considerable amount of time in talking about employment benefits and retirement planning. And last but not the least, insurance for sure. So first thing first, and I do have two screens here, so I might not be looking at the camera all the time. So you might see my side face from time to time. So sorry about that. So let's focus on some basic things about investment to begin with. So I will begin by talking about what's the basic difference between savings in general and investing. So at this point, if I may request the participants to put something in your chat window based on whatever you think about the difference between these two could be. Like whenever we refer to these terms, how would these be different from each other? Anything that comes to your mind, just make guesses or your knowledge in the chat window, please. Problem is, I don't see the chat at all. Okay, I do see now. Okay, good. Yes, savings is holding, investment is growing. Yes, savings should be liquid. Very good. So basically what we mean by this is savings is more about just holding money, and especially for short-term goals, right? And it involves any liquid and safe assets for the most part. On the other hand, when we talk about investing, we talk about how our money can grow, time value of money, and usually we refer to long-term goals. So when we talk about investing, compound interest plays an important role, and we'll talk about it in the next slide for sure. So one might be wondering then why we should be interested in investing and just not save. One of the primary reason is because we do have inflation, and inflation always reduces the purchasing power of cash. So that's an important thing to consider. So now let's talk about time value of money, which is pretty basic. And I always feel it's very important for us to realize the power or the magic of time value of money. So we'll begin with a simple example, which is, let's say we are investing $100 today for 2 years at 5% rate of interest, whatever the investment form that could be. At the end of the first year, we are supposed to have $100 for sure, and then we'll have 5% interest that we would have earned on that $100, and that will give us roughly about $105. So at the beginning of the second period, we would be now having $105, which means by the time we are approaching the end of second period, we will have $105 from our first year plus 5% interest will now be earned on $105. Now here there is a trick. This $105 that I have up here is definitely accumulation of my initial savings and the 5% interest that I have earned in the first year. So what is happening in the second year is this interest that we have earned in the first year, which was 5%, is also earning interest. And therefore, we do have not just $110, but $110.25. And we can keep continuing with this, and we will see our money is growing. So at this point, I will show you something on my Excel file. Do you see an Excel file that I'm sharing now? Okay, perfect. So it's a very basic and simple example, and we are not talking about the math or not how Excel would work here. But if you are interested to know more about this, I will be happy to take questions at the end of the session. So here is a simple example which says that if you save $10,000 each year for the next 20 years at 10% rate of interest per year, how much money would you have after 20 years? So pretty much we are saving even less than $1,000 each month for the next 20 years. So that sounds quite reasonable, right? So again, if I may request now, if you can type without taking help of any calculator or any mathematical tools, whatever value you can guess about this number. So if we are saving $10,000 each year for the next 20 years, how much money would we have at the end of the year? What would be your best guess? 60,000, 380, 68,000. Some more guesses? 25,000. Okay, thank you. So now let's see what the actual number is. Now, I mention this to my students all the time that Excel can do wonders, and we often do not take advantage of this to the fullest extent possible. But Excel will do its job only when we give proper instruction, right? So to convert Excel into a calculator, the first thing is we need to type an equal sign. And then in this problem, I am trying to figure out how much would be the value of my money after 20 years, right? Which means pretty much we are interested to know future value in this situation. So I will type FV, which stands for future value, and I will put a parenthesis. As soon as I do that, I'm sorry, there is no way I can zoom that, but you can see there are little commands that's popping up, right? So I will just follow the instruction and I will put the numbers. So I do have a 9% interest rate. We are saving it for 20 long years. And each year we are saving only $10,000. So that's pretty much what I had. And I will now close the parenthesis. And now let's see the magic. It's $511,000, right? It's way more than what we expected or maybe what we guessed. So that's pretty cool. So this is all happening because of compound interest. So if you have ever made snowballs, pretty much how we do it, we make a small ball and then roll it over the snow, right? And the ball keeps growing. Because if we do not consider the compound interest, 20 times 10,000 would have been 20,000. That's what we are saving. And if there is no compound interest, then 9% on 20,000 is going to be 18,000. So, but the number is quite big than that. So this is the basic idea about why we need to invest and why it is important to invest early as much as we can. Now, am I back to the slides again? Okay, thank you. So now we will begin by talking about some more realistic examples. Now, in the real world, as we all know, we do have inflation and we pay taxes as well out of our income, right? But just to show how this might work, we will begin with a simple example of as if there is no inflation and there is no taxes. So here is a screenshot of the Excel file that has been used to find these numbers. I will try to explain as much as I can, but this is just a screenshot, not the file at its original version. So we are assuming that our age is 30 years, which is right here, 30. And my current income is $50,000 when I'm 30. And it is expected that my income is supposed to grow at a rate of 7% every year. And I am also assuming that we are saving 15% of our money every year. So that's pretty decent amount of savings in this situation, which means 15% of 50,000 is $7,500. And therefore, our consumption level is only the leftover, which is $42,500. Next year, we will turn 31 right here. My income has supposed to grow by 7%. So I am here now. My saving rate is still 15%, but my cumulative savings is way more now, right? Because I have savings from previous period. My saving has earned an interest of 6% from the first period. And also I am saving this period as well. So this whole process is expected to continue until we turn 65. And we are assuming here for a simplest version that we are retiring at the age of 65. And when we turn 65, from that point, it is expected that we will be alive for the next 25 years. So that is going to be our retirement years, which means when we retire at 65, our cumulative saving is going to be almost close to $2.5. Sorry, I'm extremely sorry, $2.5 million. Right? You don't want $2.5 to have in your savings, right? So it's $2.5 million here. And then if we now use the concept of time value of money, we would be having for entire 1 year, for all the 25 years, $192,000 to spend during our retirement time. So that's pretty neat. And it's a pretty good amount of money as retirement planning. But here, the simplest example was that no inflation and no taxes, right? But that's not how real world works. So what we would have is, now I will introduce only inflation, and we are still disregarding taxes here. So everything else as before remains the same. The only difference is I have introduced a rate of inflation of 3%, which sounds pretty reasonable given the US history of inflation rate, or maybe it could have been a little bit less as well. Still, we do have a cumulative savings of $2.5 million, right? But that's the nominal value. With inflation, the value of our money will go down, which means it's no longer $192,000. We will have only roughly $50,000 for each year during our retirement. So you see how inflation is kind of diminishing the value of our retirement savings. So definitely that's not good. So next, if we consider now the most realistic assumption, which is we have inflation and we have taxes as well. Now, taxes will reduce our after-tax income. And in this example, to keep things simple, I have considered a flat rate of income tax, which is 25%. But usually and always here, it's the case that as our income grows, we might be falling under a higher tax bracket. So now definitely, since my taxable income is less than what my gross income is, definitely my savings amount at the time of retirement is a little bit less than before, but it's still $1.8 million. But as you can see here, the value of our retirement savings for each year is only $37,000. So that's pretty less amount. And what I'm trying to make a point here is this could be a big challenge. And this is what we are getting at the end, despite of having an okay or good salary, because by the time I'm retiring, my salary is pretty big here. I did have a good savings rate of 15%, but my real retirement annuity is so less for each year. So therefore, long story short is, it is really important to start to save early as much as we can. It is also important to look for in which things we are investing our money. And therefore, budgeting is also important. Now, some financial advisors might argue that we don't have to do so much of budgeting. It's a personal preference, but I always found it helpful. And I have heard from other people that budgeting is definitely helpful, at least to set a tone of how much your expenses are. So here is a quick tip on budgeting, which is we need to know how much our income is for sure. The next thing we can do is list all of our monthly expenses. And when we do that, we will realize that some of the expenses are fixed and it's recurring for every month, right? And some are not so regular ones. Maybe there is a festival, we are overspending, or maybe buying gifts a lot. But still, we can determine sort of like an average monthly cost for each of our expense. And then accordingly, we can make adjustment and track our progress. So there is a basic rule or tips on budgeting that most people follow. Some people would try the rule of 50, 30, 20, or some people would try 60, 20, 20. So what does this mean? This means that if we allow 50% of our annual income, or it could be 60%, for essential monthly expenses or needs, we should leave at least 30% or 20% of our income for wants and fun, because we need to have some fun as well, right? We shouldn't be just saving and working hard all the time. And then the remaining 20% we need to set aside as savings plan or tax shelter plan or retirement planning or whatever you can think of for investment for long term. Then the next important thing is setting aside emergency fund, especially several people, like we all witnessed a recession due to this pandemic in the last 1.5 years. Having enough money to cover our expenses for at least 3 to 6 months is really helpful. And last but not the least, maintaining a healthy credit score is really important as well, because then that will help us get home loans or any kind of loans pretty much on an easier way rather than having a not so good credit score. So this is pretty much what I had about some basics. And now we would be switching gear and we'll talk about what are the ways, or I would say what are some of the most popular ways of investing. The first one is definitely not a surprise, right? Stocks. We all know about this. So stocks, it's definitely very risky, but it usually pays higher return if we are holding it for a longer period of time. We have bonds as well, and bonds are usually not that much risky depending on which bond you buy, and therefore it usually pays a low rate of return. Now, anything that is more risky is always expected to pay more return so that it can compensate for taking the risk by the investors. In the US, you can buy US Treasury bonds or any corporate bonds, and depending on that, the risk level will vary. Then we have mutual funds, which is very popular among any size investors, especially among small investors, because it pulls money collected from several investors. It is invested in stocks, bonds, and any form of assets. So basically, it helps to minimize the trading fees, and it helps a lot in diversification. And we'll talk about diversification a little bit later as well. Then we do have something called ETF, which is called exchange traded funds. These are almost like mutual funds in the sense that it comprises of different assets, but they are mostly passively managed for the most part. And the good thing about ETF is you don't have to be an expert and to know about the very specific detail, because ETFs can track literally the entire S&P 500 index. It can track maybe every type of bonds that's available. So accordingly, we can invest what we are interested in. Then we have US Treasury securities. Definitely this covers US bonds. And another popular thing for short-term investment is US Treasury bills. And last but not the least, cryptocurrency, right? Recently, it has become very popular. It's not just Bitcoin now. There are so many versions of cryptocurrency, Litecoin, Ethereum, and so many of them. So these are basically some important investment types that we can think of. Now, let's consider some historical returns on different types of investment. And we are talking about only stocks and bonds here. So again, if I may request my participants and attendees to make some guesses about what do you think that in the US, the average return on stock market has been in the last several years. What would be your guess? 7 to 10%, good. 9%, 17%. Okay, that's good. Now, what about the bonds market? What would you guess that in the US history, on average, how much bonds have earned us? 1.5, 2%, 4%, good. So it's definitely going to be less than the stock for sure, right? So let's see what we have here. So over the last several years, large stocks in the United States has given us 10% per year, and any long-term government bonds, not corporate bonds, has given us anything between 5 to 10, 6%. Sorry, not 10, 6%. And as of June 2021, the average 10-year stock market index has been 9.2%, according to Goldman Sachs. So here we see that there is a difference in interest rate that bonds and stocks are paying. So definitely we can say that risk plays a big role in any investment decision. And risk is definitely to be considered whenever we think of any investment decision. So to make a link between risk, now I would be talking about the two broader types of risk that we have in any country or in the world in general. And then I will introduce what's the basic need for diversification. So there are two types of risk that broadly exist in any market, in any country. One is called systematic risk. It means something that is inherent in the entire economy or market. There is no way you can get rid of it. Political stability, then, it should have been political instability, currency fluctuations, natural calamities, and whatnot. And then we have unsystematic risk, which means any risk that affects only a particular sector or industry. For example, regulation, insolvency, and competition. So in summary, I can say that not all risk is equally assessed. So what do we do about these two types of risk? And there comes the importance of diversification. Here I have tried to create a bar chart. As you can see here, there are 3 bars, right? One in the left, most extreme. We do have investment in only one stock or one bond, doesn't matter which one it is. And here, as you can see, the blue color represents systematic risk and the yellow black checkered represents unsystematic risk. So when we are just investing in only one stock or one bond, right, we do have considerable amount of systematic risk and also unsystematic risk because we haven't diversified our portfolio. When we move to the middle panel, we do see the systematic risk has remained the same, right? But the unsystematic risk has reduced a little bit because I do have some diversification in my portfolio. The extreme right one shows with several different combinations of assets, I was able to almost minimize my unsystematic risk, but systematic risk still persists, right? So whenever we talk about diversification, we talk about unsystematic risk that we do have some control to minimize or to avoid completely by having a very diversified portfolio with different combinations of assets, or maybe if you are only interested in stocks with different combinations of stocks. But unsystematic risk will definitely stay with us, and a good amount of or good mix of different asset types therefore is really important. Okay, next, I want to show a quick scenario analysis here, because oftentimes you will hear that people while investing, they just think about a very short-term period. We had a recession in the last few months or year. The stock market might not have given us better returns, so I should be very much pessimistic. Or maybe last year it was really great. One stock has given us 20% return. Oh, great, fine, let's invest in it, right? So instead of doing that, it is really important to consider a scenario analysis where we consider what are the possible situations that a country can face. So I do have 4 quick scenarios: severe recession, mild recession, normal growth, and boom. And as you can see, each of them has an probability associated with them. And definitely severe recession has the least probability because it's least likely to happen. And to make things simple, I have considered only 2 different types of assets. One is a stock, one is a bond. And each of them do have an associated rate of return with it, right? Normal economic times, 14% rate of return on stock market sounds very reasonable. If we have a mild recession, it can be as low as negative 11%, right? And then I do have some associated rate of return for bonds as well. So basically, I'm just trying to take an average, but since it involves probability, therefore it has uncertainty. So probabilities become the weights. And therefore, on average, I see that stock market will give us maybe 9.2% rate of return, and bond market will give us a 4.9% rate of return. So again, I will repeat that considering a scenario analysis is really important so that we can see how a specific stock or just the market in general has performed in the last several years. Okay. Now, the last thing that I will talk about in this particular subtopic before I switch gear is trading platform. So as much as knowing about investment is important, of course, to know about trading platform is equally important, because otherwise, how will I even do the investment, right? So it was a really nice summary that Business Insider published it last month, with a list of apps which are very popular among investors these days. And as you can see, not surprising, Robinhood lists here as well. And it's very popular these days. It's mostly for active traders or investors, and it does have 0% trading. So on campus, at least several of my students do have Robinhood account as well. And then we can look for some sophisticated account or maybe investment apps, and that can have like some sort of fees or maybe some additional fees that we have to pay in order to do investing through them. Okay. So next, I will switch gears And we'll talk about employment benefits or retirement planning, because this is really important. And we all should be paying extra attention when we are starting our jobs, or especially if we are in our initial years of career, because a good deal of investment management because a good deal of investment management in practice involves around the individual's lifetime savings and investment planning. So retirement, purchase of a home, or maybe financing for children's education are three major objectives of savings in every household, or I would say most households. We can also consider things like inflation, emergency fund, taxes as well, and how much insurance we pay, or I would say insurance premium we pay every month. So we need to plan for consumption smoothing, which means that even though when we retire, we do not have a direct flow of money from my job, we should be able to support ourselves as much as we can. So now, in planning for investment, knowing about tax shelters is really important. So what we mean by tax shelters mean ways to postpone our payment of tax liabilities as long as possible. So there is no way that we can avoid paying taxes, but definitely there are ways so that we can defer paying taxes until we have the time. Until the time is appropriate. So basically, there are two types of investment planning. The first one is defined benefit plan. This is one example from the good old days. I would say this doesn't exist that much anymore, or I would say this doesn't exist at all. It was usually based on employees' salary, age, and let's say the term of tenure with a specific company. One example could be like, whenever I retire, maybe at the age of 65, whatever my annual salary would be, 75% of my last salary would be paid as retirement. That's amazing, right? There is no risk associated with it. But now we do have defined contribution plan, which means these are based entirely on the contributions that we make from our paychecks. So based on that, there are three popular ones that we can talk about. The first one is 401k plan, and it is mostly for the private sector that we call it 401k. But if we are talking about any non-for-profit organization, the name is 403b, and it can have different other versions as well. So there are two different forms, traditional and Roth, and I will explain that just in a moment. Next, we have IRA, which is individual retirement account. Again, it does have both traditional and Roth. And the last one is Keo plan or solo 401k. So let's talk about 401k first. 401k is available through employers only. The employee contributes a set percentage of income every month from his or her salary. Some employers, for the most part, offer a matching amount, which can be either the full contribution of ours or a certain percentage of our income. Contributing at least the maximum percentage such that your employer will match is really beneficial, because whatever the matching amount would be is actually the free money that we would be talking about. So if I am contributing $600, Wabash will match, let's say $600. So that $600 is just a free money. So having a 401k is strongly, strongly encouraged if your employer is providing it. And definitely the money will grow if it is invested in an interest-bearing plan. So now some people wonder, what's the difference between traditional 401k and Roth 401k? The most important distinction is, for a traditional 401k plan, contributions are made pre-tax. So let's say my gross salary is $1,000 per month. I pay my contribution first. Let's say it's $100, and then $900 becomes my taxable income. So it helps reduce our taxable income. Whereas for Roth plans, contributions are made after tax income. So that doesn't help reduce the adjusted gross income for tax. But definitely there is no way we can escape not paying taxes. So since 401k did not involve paying taxes when we were putting the contributions, we have to pay the taxes when we withdraw our money later on. Similarly, in the Roth plan, since we have already paid our taxes, we do not have to pay any taxes when we withdraw our money. Now, you might wonder then which one is preferred. Again, the answer is it depends. But Roth 401k is very popular among young people, mostly for two reasons. One, it is expected that our salary is expected to grow as we get older, right? So it is a good assumption to make that currently, if I am young, I will be falling under a lower income tax bracket. So if I am paying the taxes now, I don't have to worry about paying taxes later on when my income tax bracket will be higher. Another reason can be it's very much less likely that the tax rates will go down. It will either stay the same or it will increase. So in order to avoid the uncertainty of tax rates, some people prefer Roth as well. Okay, can we contribute as much as we can? Oh, I wish, but no. The IRS has set the limit, and currently for 2021, it is $19,500 per person. So the next question can be, okay, what about when I can withdraw my money from the 401k account? We can withdraw our money as soon as we turn 59 and a half years old, not before that. Well, you can withdraw, but then we need to be prepared to pay 10% additional penalty. And about taxes, if it is a traditional 401k plan, no matter when we withdraw, before or after 59 and a half years of age, we will be paying taxes for sure. But there is some exceptions for not paying the penalty, which is if there is some extreme financial needs or maybe some disability. But no matter what, as soon as we turn 72, we must withdraw some amount of money, and that is what is called the required minimum distribution, or RMD, which is also set by the IRS. Now, if you are already 59 and a half years old and you are still employed, and let's say you worked for another employer previously, definitely you can withdraw your money penalty-free for sure. But with your current employer, you need to check their policy, what policy they have, and accordingly, we should be able to withdraw our money. Okay, IRA. Unlike 401ks, it's individual-based account, as the name itself says, individual retirement account, right? As long as we have a job and we receive a taxable income, I can open up an IRA account. I don't have to be dependent on my employer. And it does have both traditional and Roth plans, and it works similar way as well. So now, which one is better? Well, again, I would say it depends. But there are some prospects in both of them, and some not so good prospects. So first one, 401k offers very specific investment opportunities. So we do not have a lot of options to choose from. Whereas IRA, we can definitely choose the investment type. 401k plan, it's employer sponsored. IRA is not, which means it doesn't have any concern when we are changing jobs. Pretty much anyone can open IRA if we have a taxable income that we are earning. The most fun part is this third one. In 401k, we do get a matching contribution. IRA, no matching contribution. So we miss out the fun money in IRA. Again, another benefit of 401k is the maximum contribution amount is way higher, which is $19,500. But for IRA, it's only $6,000. So that's pretty less as well. Now, which one is better? If you again ask me, my answer would be this. If you are not thinking of a very generous savings plan, I would strongly recommend you to start with 401k if your employer is providing it, because you do get a matching amount, right? It's really not a good idea to have that matching amount just go away. So we should go for that. And then if our saving is very generous and I have maxed out the 401k contribution limit, then definitely we can move to IRA. So pretty much we can have both. It's just that you have to take a call if you want to do both. And if you have to choose one, then definitely it's going to be 401k if your employer provides it. And the last one is KEO plan or solo 401k plan. And it's typically always for any self-employed people or business owners. Solo 401k is way popular than KEO plans because KEO plans in the recent few years have become a little bit unpopular, and it tends to be a little bit difficult in order to set it up. Okay, in the last few minutes, because I want to leave time for questions as well, we will talk about insurance. Because as much as planning for retirement is important, insurance is important, definitely. So usually when we get insurance is particularly in this situation, anything that has a low frequency, right? But whenever it will happen, it will have a high severity. So what insurance does is basically it helps share the risk with the insurance provider. So it is one of the tools of risk sharing. So what are the types of insurance that we have? The most important and very popular, of course, it's health insurance. And if your employer is providing it, definitely that's the best way to go, because if you want to buy the same insurance plan from outside, it is going to be very costly. And then under private insurance plan, we do have HMOs and PPOs. HMOs are usually provided by non-for-profit organizations, and it is very selective in choosing a primary care physician, and it's less flexible than PPOs. So therefore, PPOs are more expensive than HMOs. And then in the United States, we do have public healthcare, health insurance, which is Medicare and Medicaid. Now, when we talk about health insurance, we can choose between these two. One, every month I pay high premium, but then when I do have a big expense, I pay a low deductible. So that's a trade-off. Versus I pay a low premium now every month, and then if I have a big health expense, I will pay a high deductible. Usually young people with no underlying health conditions usually prefer this option. But again, it's also a matter of risk aversion, how much you are willing to take the risk. Getting vision and dental insurance is equally important because health insurance doesn't cover those. And of course, we can talk about auto insurance, fire insurance, burglary insurance. There are so many types of insurance these days. Okay. Now, this is quite interesting. When we know about insurance, we usually do not associate this with any form of tax shelter, but actually it does exist. So in 2003, the Bush administration introduced this as health savings account, which is HSA. It is a way of saving for healthcare cost. Any distribution that we contribute to HSA are tax-free as long as they are spent for qualified medical expenses. So that's pretty good. There is always a possibility of investment gains if we are investing it. And the best thing about this is if there is any unused fund every year, it rolls over to the next year. So pretty much you do not lose the money that is left behind. So that's another good thing. So who is eligible for HSA? In order to be eligible for HSA, you must have a high deductible plan. Otherwise, we are not eligible. We are not covered by any other health insurance, and definitely we cannot be enrolled in Medicare as well. So the last one is flexible savings account, which is FSA. That is also pre-taxed, but the downside is unused funds will never roll over. So let's say I know I do have a sure short health expense next year. Maybe I'm getting a hearing aid, right? Or getting it replaced. or maybe I'm getting crowning for my tooth. I know that expenses will be there next year. So it is definitely a wise decision to set aside money in FSA, because when we make those expenses, it will be covered, and definitely I will be saving taxes on that as well. Because if I am contributing, let's say $2,000 into our FSA account, and the the tax rate for that year is 30%, pretty much we are saving $600. So that's a good deal as well. And last but not the least, life insurance is very important. If your employer is providing it, I would say opt for it, because it's not for us, but it is for the beneficiaries if something happens to us. And for the most part, the money can be used however way we want to use. I mean, not we, the beneficiary can choose to use, right? On the other hand, disability insurance is really good for people who are working, because just in case there is an extended period of time when I am ill or I do have an injury, it does pay a portion of our income as well. So make sure when you are getting a job, you are switching employers, talk about your employment benefits thoroughly with your HR manager or whoever the person would be representing from their side. Now, I would wrap it up by saying only one thing, which is it's never too late to invest. And as the popular saying goes, the best day to invest was yesterday, and the next best day is today. Now, since it's almost 8:30 p.m. in the East Coast, right? For us, it could be the best day tomorrow, because it's pretty late to think about this maybe now. So with this, I wrap up my talk. Here is my reference slide. And thank you so much for listening. And I will be happy to take questions that you might have now. Thank you so much.
Hi, Dr. Saha. This is Mazen Hakim,
Hi.
class of 2017. I have a quick question about the 401ks.
Sure.
But first, thanks for the talk. This is really informative. I appreciate it.
Thank you.
So for the 401k, are there any like risks associated with having that account, or like if the company is bankrupt after a certain amount of time, or is once you make a deposit, is it guaranteed for you?
It's not guaranteed because it is going to be invested, right? So it is going to be invested. So pretty much you can consider maybe it will be invested in big and good mutual funds, Charles Schwab funds or index like that, right? So depending on how the market does, your money will go increase or decrease in value. But again, we are talking about a long-term period, right? So if I'm 30 now and I'm not going to retire until 65, for the next 35 years, even though sometimes the market goes down, it will again regain, right? So definitely there is risk, but it's worth taking the risk, because at the end of the day, you will get your money for the most part when you retire.
But just to be clear, it's not dependent on the company's well-being, correct?
It is depending on in which mutual fund it is invested. Yes.
Okay.
Can I step in there? I'm a 401k professional. So the question you're asking about the credit of the business, if your company were to go bankrupt, your assets are protected in that case. Now, in a 457 plan, if it's a tax exempt plan you're participating in 457, that's the only type of plan that wouldn't be protected from creditors. But if your company were to go bankrupt, you would be protected. But what she was talking about is your investments. Yes, those are still subject to market risk. And in a 401k plan, you have to, in coordination with whoever you rely on for financial advice, pick your allocation.
Yeah, thank you. Thank you for that. Yeah, I didn't get the question quite right. Yes, your money is protected. And whatever the market would perform, based on that, your value will increase or decrease. But even your company goes bankrupt, it should be okay.
Thank you.
Just one thing I would add, because with mine, my company does have stock, which is part of our 401k. So unfortunately, if the company goes bankrupt and I am over invested in my company's individual stock, that will be at risk.
Yep, yeah. That's another caveat to consider, and definitely want to diversify.
Yeah, that's a very good point. And therefore, diversity is important, right? Because if we are relying heavily on one specific company or bonds and things like that, it will have risk, because then the value of your portfolio will go down because the company went bankrupt. Okay, next question. You can, how do you, is it Roger? You are muted. You are muted again.
Now,
There you go.
can you
Now
hear
we
me?
can hear you.
Yes.
Good.
Yes.
I was Roger Alley, class of 63, and I have a strong interest in dollar cost averaging and extensions of it. Is this something you're familiar with? And
Say it one more time, please, Roger.
dollar cost averaging, a mode of investing?
No, no, no. I am not that much aware of it. Like, but I can welcome anyone who is aware of it to share anything that they know of.
I can add a little bit about dollar cost averaging. So it's really a theory that there's no ideal time. You don't want to try to time the market.
Yes.
That's inherently risky. So if you know ideally each year what you want to contribute to whatever retirement vehicle you're going to use, the theory is to put in equal amounts at the same interval over the year, so that no matter what the market is doing, you're going to have some units that buy in at the top of the market, some that buy in maybe during like we call a correction, where it's 10% lower than when it's most recent highs, and that gives you a higher chance of realizing the average market returns as opposed to an outlier.
Mm-hmm. Yes. Is this something you're familiar with and interested in looking at more? I've been looking at extensions of it. And
Are you asking me?
Oh, well, I was asking Steve. I think he was speaking.
Okay.
It's just an approach. It's just a theory.
Okay.
Most financial professionals would recommend taking that as opposed to putting all of your contributions in for the year at the same time. Yeah.
Okay. Thank you.
Mm-hmm.
Okay, I do have some questions in the chat. Ali Hakim is asking, are 401ks and IRAs managed by an institution or individual? 401k is institution. Like I remember with Wabash, I have my 401k account. I met with a representative and he helped me choose which investment plan I want. So I would say it's passively managed, right? I choose the plan and that's how it's kind of managed. IRA, you can manage it because IRA pretty much you will open up the account with any brokerage firm and you can manage it for sure.
Yeah, I'll add with the 401k plan, you get a restricted number of mutual funds usually to pick from. With an IRA, you're open to individual stocks or mutual funds or ETFs. So definitely still consult with a financial professional to find out what asset allocation is best for you. But the advantage of a 401k plan over an IRA is that typically the expense ratios you're going to see are much lower because you're putting your money in there with everybody else's.
Yeah.
Have a higher purchasing power.
Yeah.
Thank you.
Nick Freeman asks, with matching funds from the employer, once they enter the account, they are fully my funds, correct? Oh, yeah. So,
so let me hold on. That was for the contributions that you put into the plan, that is correct. It's 100% vested. For what your employer puts in, that could be subject to a vesting schedule. So you should refer back to your summary plan description, talk to your HR, verify how many years of service you may have to actually work to get all those when you leave.
So in that case, if I may add here, and I would say several employers do not provide any matching contributions when it's just the first year of your job, right? I believe that's kind of pretty much standard. So they will start putting some matching contributions if they wish, only when you have worked at least a few years. Some companies can start as soon as second year, but not definitely at the first year. But yeah, and the withdrawal can also be subject to how much you have worked with the firm.
There's a, Sujata, there's a chat, change up gears a little bit here. Is purchasing land a good way to diversify?
I would say yes, but it also depends like which area are you buying? Does that specific location has perspective of increase in property price? If yes, definitely it's a good idea. You can definitely go for it. But in some towns in United States, there is not that much scope of increase in land prices. So consider it, but definitely investing in houses, multiple houses or land is definitely a good idea. And it will help in diversification because you are not relying on the market that much. Well, I would say it definitely depends on how the country is doing, but what IBM stocks are doing doesn't that much relate to what the land price is, right? So that will definitely help for sure.
And Larry, did you have a question? Your hand was up earlier.
You're on mute, Larry.
I'm a class of 72.
Hi.
Hi. I'm a retired CPA. I married a girl who had a master's in accounting. And there's one area that I would maybe give to everyone, to the young people.
Yes, please.
Part of good financial management is marrying a person who shares your values. Because sometimes savings and investing is going to be really hard. And it really helps if there's someone else there with you. And also, everything that Professor Saha said is true. It was a very good presentation.
Well, thank you so much, Larry. Thank you.
That's it.
That's great
we do
advice.
have-
I told you in the beginning, experiences do matter, right? So thank you for
does.
sharing.
we do have time for one more. Does anybody have?
Yes, please. Yeah.
There's a question about eligibility for traditional and Roth IRAs. I can take that one if nobody else.
Which one is that? Is it
Is
in the
what are-
chat?
Yeah, and Edward Evans asked, what are restrictions on whether you are eligible to contribute to traditional or Roth IRAs?
So I can say start and then you can add, Steve. So are you talking about restrictions on the amount or restrictions with regard to age? So if it is the amount, I would say like IRA, I believe as long as you are old enough to have a job and if you receive a taxable income, right, you can open up an IRA account with any brokerage firm. So that's, I would say, right, Steve?
At a high level, yeah. Some more specifics to add to that would be the maximum amount that you can contribute each year is much less than a
Oh yeah,
retirement plan.
so that
You
was one
can
of
only
the
do,
slides as well I was showing. It's
Yeah.
only $6,000
And then
set aside.
if you, it also, so your eligibility to contribute to a Roth IRA also depends on your adjusted gross income each year.
Yeah,
So
that's what I was getting at. That's where I was trying to go.
Yeah,
So,
yeah. If
yep.
so, definitely look at that each year. It goes up with inflation
Yeah,
each
it
year. It's around
changes every year.
$200,000. So definitely consult with your tax preparer on that in
Yeah.
terms of.
IRS definitely changes that. And some people contribute to both as well, right? Depending on their situation and what they feel about paying taxes now or later. But always keep in mind that no matter if you are splitting it or not, your total contribution, including both the accounts, will still be add up to the maximum contribution limit set by the IRS.
Okay, excellent. A quick follow-up to that. Are there any gross income restrictions on traditional IRAs?
Like you mean how much my money can grow under IRA? Is that what your question is?
No, how much income you bring in that will restrict you from being able to contribute to traditional IRA? Like you have a limitation on Roth IRA?
You can contribute what you like to it, but
Yeah.
how much of a tax break you get on it depends on your income each year.
In your income, yeah.
Okay.
And I see that Heidi put in here a good book that she recommends, The Simple Plan to Wealth.
Oh, thank you.
So I'm going to close it up. I get 8:31 on my watch. Thank you all for joining. A couple things. One is check out future events. Like I said, wabash.edu/www. You'll also be receiving a survey from me over the next day or two, maybe early next week. We do this after each of these events so we can make them better as we go along. So check that out. And we'll look into getting you the slides. I'll talk with Dr. Saha about that. And finally, thank you, Dr. Saha, for your time. You got a busy, full schedule of teaching this semester, but you were still very willing to step up and take this hour, and additionally, all the preparation you did for this session, for doing this for our alumni, parents, and friends.
No,
So
one
we
thing I would add is I was telling this to one of the colleagues this morning. I guess so far I have presented in several occasions, but it was always maybe at an economic conference or a colloquium with like faculty that I have known or colleagues I have known. So it is the first time I would say in conferences, definitely I do not know all the people, but at least I know everyone is from economics, right? So this is, I would say, one of the first presentations that I gave to a broader audience, right? I have someone from class of 1963, 82, and then also recent graduate as well. So it was really nice doing this. And thank you so much for listening.
Thank you very much. This was great. And Steve, yeah, nice work. Thank you. This is cool.
Thank you.
Thank you, everybody.
Have a good
wabash.edu/www. Thank you, Sujata. Take care.
Yeah, take care.